Hey everyone, welcome back to the Finmineering channel, where we aim to simplify mining finance and engineering. Today we're looking at New Gold, a Canadian company with ticker NGD and 2 operating mines in Canada. Recently it was announced that the company would be acquired by Coeur Mining, a US-based company. Join me as we take a closer look at the deal and what you should expect. This video is going to form part of a 2-part series. In the first video, we're going to take a look at the deal that was announced, the valuation, and some of my insights into the matter. In the second video, coming next week, we're going to look at the technicals of effectively what Coeur is buying. New Gold has been making waves lately with a strong ramp up at production at its Rainy River mine in Ontario and strong cash flow performance, particularly till the back end of calendar year 2025. Before we dive into the details of the deal, let me give you a quick rundown of what New Gold is all about. The company was founded in 2005 and is headquartered in Toronto. It's got 2 operating assets, one being the New Afton mine located in British Columbia, and the other is the Rainy River mine located in Ontario. The Rainy River mine is an open pit and underground operation producing gold and silver. It started commercial production in 2017 and is the largest asset by volume. The second asset, New Afton mine, is an underground block cave mine producing gold and copper concentrate. New Gold recently achieved a huge ramp up in production at the Rainy River mine, boosting sales and cash flow. Coupled with gold prices and copper prices, the company seems to be doing really well. So why is it trying to sell out? Let's find out. Late last year, it was announced that New Gold would be acquired by Coeur Mining, a US-based company, on the 3rd of November in 2025. It is an all-stock transaction valuing New Gold at approximately $7 billion US. The deal, which is expected to close in the first quarter of 2026, subject to shareholder and regulatory approval, seems to still be on track at the time of this recording. New Gold shareholders would receive almost half a Coeur share for each New Gold share that they own, representing a 16% premium to the closing price as when the deal was announced. So what should we expect the outcome to be of this acquisition? Well, Coeur wants to grow into a larger, more diversified company, potentially becoming one of the top precious metal producers in the world. Coeur believes that the 2 assets of New Gold would complement its existing 5 operational assets. Growth through acquisitions is a pretty common strategy, and given that New Gold's assets are currently operating, the acquisitions should be value accretive from the onset. Organic growth through the development of your own assets or tenements can be quite time consuming and expensive. This is mostly because of the extensive due diligence work and study work that's required, and also the permitting can be quite rigorous. On a pro forma basis, Coeur should expect to achieve a market cap of around $20 billion after the acquisition. It would then consist of 7 operating assets in North America and produce about 900,000 ounces of gold and 100 million pounds of copper. Is New Gold overvalued? Well, I don't think that is the right question to be asking. Keep in mind that transactions of this nature usually involves a lot of study and due diligence work. The potential buyer would usually get access to a lot of information that is not publicly available. This information would be used to perform detailed financial modeling to see if the company would be willing to pay the price. In addition to the financial valuation, there would be a lot of technical work and other aspects that would need to be considered to calibrate the financial modeling. Ultimately, the buying party wants to pay as little as possible for the asset, and the selling party wants to achieve a higher sale price. If I was involved as a buying party, I would be looking to establish my own base case, taking into account the technical and other due diligence considerations to form a view of what I think the company is valued at. I would consider a range of metrics such as NPV and IRR. NPV and IRR can be misleading when used in isolation. NPV is often skewed by production that is incurred later in the mine life and unrealistic capital and operational spend forecasts. It's particularly true with mines that have a lot of variables in their mine life and generally has a shorter mine life, say less than 20 years. I use NPV and IRR more as a sense check as to whether the deal is solid or not. I consider the cash flow to be the more important metric for me. I would look at cash flow over the next 1, 5, and 10 years respectively. What I'm trying to see is whether or not I can or I want to spend the amount of money it's going to take to keep the new assets running or even grow its production. For example, the New Afton mine is an underground block caving operation. Now, without going into the details too much, let me just tell you that underground block mines are really expensive to develop and you don't get any return on your investment for the area that you're developing initially. But once you've invested all that capital money and the mine becomes operational, you start repaying that investment through very low operating costs. So we need to consider what our current cash flow profile looks like with the existing assets as well. If we cannot afford to fund each asset's growth strategy as is at the same time, compromises are going to be required, and then we have to adjust the base case accordingly. On this basis, we determine then whether the acquisition is value accretive for us or not. It is not so much about the sticker price at the front end. It's about what are we going to do as a company over the next couple of years, and can we afford to do that? Outside of the due diligence, we have investors and analysts who try and value these sort of deals without having access to all the due diligence information. In these instances, you would hear a lot of analysts and investors talking with a bunch of acronyms like EV and EBITDA and talking about all sorts of multiples. The issue is sometimes that analysts and investors determine what the market price is of companies. Ultimately, the share price of a company is determined by what someone is willing to pay for it. And these can be quite detached from what the fundamentals of a company would suggest. A company's valuation determines its buying power, particularly when it's a scrip deal, such as what's in play here. Companies are often left frustrated by analysts as there may be a natural conflict at play. Analysts and investors determine the value of a company based on information that is potentially misaligned from the detailed information that the buying parties would have access to. The incentives may also be different from buying parties or mining companies in general versus analysts and investors. As a mining company, you probably have a very optimistic view of what the future may hold, and you want your company to be as valuable as possible. As an analyst, you may be a bit more skeptical about what the future holds, and as a result, you may be more conservative in your valuation of companies to protect your own interests. Most people do not realize how much engagement there are between mining companies and analysts, particularly after announcements and deals like these. Ultimately, what they are trying to achieve is to align their models and valuations to paint a more accurate picture of what the situation is. Let's take a quick and relatively simplistic view at how New Gold may be valued using publicly available information. New Gold's implied EV to EBITDA ratio is approximately 8.5 based on the past 12 months performance. Now, you don't have to calculate this ratio yourself. You can look this up on Seeking Alpha, Simply Wall Street, or even Yahoo Finance. I'm not affiliated with these companies anyway, but these are easy resources for you to obtain this information from. Keep in mind that there may be some slight variations between these websites for these ratios, as they use slightly different ways to calculate the information. Broadly speaking, the results should be about the same. The other thing to keep in mind is that you can also look at the forward-looking data to determine this EV over EBITDA ratio. Maybe before moving on, let's just touch on what the EV to EBITDA ratio actually means. EV over EBITDA stands for enterprise value over earnings before interest, tax, depreciation, and amortization. It is a common approach for valuing a company to see if it's over or undervalued, especially for acquisitions, by providing a debt-neutral comparison across different capital structures. It shows how many times a company's annual EBITDA it would take to buy the entire business. Let's have a look at some of the peer comparisons. In this table, you can see that the New Gold trailing EV to EBITDA ratio is about 8.5, and the forward-looking one is about 5.7. Other companies, Equinox Gold, IAM Gold, Kinross, and Oceana, are showed on the screen. The New Gold valuation is not completely detached from its peers, so no red flags at this stage. Now let's look at this slightly differently. There is a strong correlation between New Gold's share price and the gold price in recent times. In this graph, we can see that in particular for calendar year 25, the relationship between the blue and gold line here are quite similar. What this means is that New Gold is likely fully valued, and its share price will only really fluctuate with the change in commodity prices in the absence of structural changes to the business. If prices drop post the acquisition, it's going to look really expensive. And vice versa, if prices keep going up, it's going to look like a great deal. What do you think commodity prices are going to do in calendar year 2026? Let us know in the comments below. So what do I think about the deal personally? I believe that New Gold thinks that it's a generous offer, and that's likely based on their view of what commodity prices are going to do over the next couple of years. Also, the company may not have the appetite to keep funding the growth projects required to keep production going at New Gold's assets. To me, the spike at the Rainy River Mines production in Q3 of 2025 seems a little bit suspicious. I mean, it's a great achievement, don't get me wrong, but Coeur likely knows what it's getting into, and it's probably got its own view of what commodity prices are going to do. The benefits of having a more diversified portfolio and its view of commodity prices probably lets it see this as a good acquisition. I don't know the motivations of either Coeur or New Gold, but personally I think buying assets or companies at the top of the gold cycle, and yes, I think gold is close to the top of the gold cycle, is probably not the best idea. Rather, I would strengthen my balance sheet and then focus on trying to buy the dip. If only life was that simple, right? Ultimately, no one knows how a rock will break, and it'll be interesting to see how this deal pans out over the next couple of years. Thanks for taking the time to get this far into the video. We hope it was valuable. If you did find it valuable, please like, subscribe, and share our channel. Until next time, see ya.